For more, we're joined by Michelle Schneider. She is Chief Strategist at MarketGauge. Michelle, good to have you on again. So that relief rally we're seeing after the Fed's meeting announcement, I mean, what about it has calmed investors, which really have been quite jittery in recent weeks over those tariffs back and forth?
Well, basically, Powell came across as somewhat modulated in that he said it could be worse, but it's not so bad right now. However, he definitely spelled out what could get worse, obviously expressing his concerns about the economy and inflation at the same time. But I think what the market reacted to positively was the rollback of the quantitative tightening from 25 billion a month to 5 billion a month. And so the market interpreted that as somewhat QE in essence, or a reduction of QT being the same thing. And the question is, of course, what happens initially after a Fed meeting? What is the follow through 24 hours later? Often we see the reverse happen. So it remains to be seen just how optimistic the markets will be based on this information today.
Yeah, so lots to, wait out for. But Jerome Powell also appeared kind of measured in his response on how Donald Trump's tariffs would impact the economy. He used the word transitory to describe the impact. Do you agree?
Well, it's an interesting choice of words considering how much trouble he got into that in 2021. But nonetheless, what I think he's really trying to say in being very cool, calm, and collected is that the tariff impact on inflation could be transitory. And we know that that is certainly the case and obviously what the administration hopes for. But there are other factors involved with what could drive inflation higher that I think we still have to look at as investors. Of course, we still have a huge debt. We still have a lot of government spending. The lack of regulations, of course, could lead to even more free spending, if you will. And also on top of that, they're talking tax cuts and they're talking even bonuses for people here in the United States based on what Doge is saying. Plus, we have geopolitics which have not calmed down. And then, of course, we have the factor of the dollar and rising gold and silver. So his word transitory, you have to look at it for what it means, specifically on what long-term impacts tariffs could have, maybe not as long-term as one would fear.
And just, picking apart the other stuff that he said, something that's also interesting is that the Fed talked about slower growth, higher inflation ahead. And so this should be bearish for equities. So kind of help us understand why they still rallied. Is it all on because of the rollback of the QT, or is it also got to do with them, sticking to that 2 cuts this year? And tell us if this would significantly help markets kind of turn the corner after the bruising couple of weeks that we've seen in the equity market.
Well, I think the simplest answer that I can give you to this very complicated question is that you have to watch the consumer area of the market. It was really the consumer that brought this market down and started the free flow, if you will, of liquidity out of the market. The consumer confidence has been bad. Retail sales have been bad. We've seen a lot of the stocks in the retail sector go way down. And essentially, considering that the consumer is 70% of the gross domestic product, and inflation, of course, is going to hit the consumer, that bounced a little bit along with the market, but it had such a devastating fall. While the S&P fell 10%, the retail sector fell much more like 15, 20%. So this could just be sort of a bear market bounce, although I don't say we're in a bear market, but that sort of correction territory bounce. And if that cannot continue going up, and we can look very specifically, Liz, at XRT, which is an ETF, a basket of discretionary and staple consumer stocks, if that can't get much more of a bounce from here, I would think that we could start seeing a little bit more unraveling. If it finds firm footing, then perhaps the worst is behind. But I'd say the jury's out on that right now.
Michelle, investors, they have been slashing their holdings of U.S. equities. But given the indications from the Fed on its rate cut trajectory and, the less hawkish projections, should investors be directing capital back? And if so, where? I mean, cyclical sectors, they were up after that Fed decision. Consumer staples are also kind of picking up momentum there.
Well, right now, I think that there's a lot of talk about how valuations are so low and the stock prices offer these great opportunities for people, particularly if you're looking at the Mag 7. And I think that's the narrative that we've had for the last couple of years, but not necessarily the right narrative, because if you look across the board, what has been rallying has been the energy space, gold, silver, copper, even some of the food commodities and some of the soft commodities. So as far as I can see right now, this little bit of consolidation that we're seeing in agricultural, soft commodities, and precious metals is probably the better opportunity to invest than trying to pick a bottom in stocks until we see right now what happens with that consumer. Now, with that said, there are a certain area of stocks that may get a pass, not only on tariffs and inflation, but also on pricing power, and that it may not impact the consumer as much. And those have been stocks that have been sort of basing out. So you're looking at things like Intel, which came off today, but still it's been sort of trying to base, or Stratasys, which is another stock that has been basically basing out. It's a 3D printing for NASCAR cars. Some of the car companies themselves, like Rivian, that might get a pass on all of that, is also starting to do well. I mean, there's a whole myriad. IBM has done extraordinarily well, even in the face of the sell-off that we've had recently. So I guess the key really for people, what we're recommending, is to look for things that are basing out and then breaking out, as opposed to things that have been on a falling knife and then hoping that this bounce is actually a bottom, unless you have some real good risk controls in there.
All right. And also one more thing is that back on the QT bit, so the Fed indicating that it will slow the pace at which it will shrink the size of its balance sheet. Would this bode better for bonds ahead?
Well, a lot of people think so. I mean, again, if you look at the long bonds right now, they have been holding not quite as high as they've gotten to, where we saw the Fed funds rate drop down closer to 4. But if we're going to be looking at a range, which is what we sort of predicted, of 3.75 to 4.5, it means that the bonds may have some movement up. But I wouldn't necessarily be putting my money into bonds right here, because if the yields fall further and the bonds go up, and especially if we cannot get these growth stocks in other areas that have led to participate again, what have we done, Liz? We've made another bull case for a lot of the commodities and a lot of just sort of the hard assets, things that people need and what the whole country needs and the world needs in terms of energy, especially for these AI and data centers.
All right, Michelle, always good talking to you. Michelle Schneider, their chief strategist at MarketGauge.